Let me bring it forward now and talk about some of the other risks out there. How big a risk are some of these trade tensions that are out there? And how much concern do you have about China's weakness hurting the U.S.?
So I think the trade tensions, if they're not resolved, can be a significant negative for the outlook. We're already seeing some impact on business confidence, and I think we could see a negative impact on investment spending and possibly also on consumer spending. Some of the soft indicators, the sentiment indicators have weakened some. So I would worry about that. And Chinese growth clearly looks to have slowed, both from their numbers and the reports you're hearing from American firms doing business there. The Chinese really want to control the growth of debt, and they don't want to stimulate spending using the tools that they have used in the past, opening up the credit taps as they did after the financial crisis. They'd like to stimulate consumer spending, but they do have policy tools, and I anticipate that they will use them to continue to spur growth, although growth in China is on, and has been for some time, on a slowing trend.
You put the reduction of the balance sheet on autopilot, essentially. I don't know if you would own up to that, but
I will confess.
Will you confess to that?
I will confess to having used that word.
That you used that word? You said it's as boring as watching paint dry, and Jay Powell used some of those terms, and he got in trouble for using them.
He did.
Do you think that was a mistake, and is it right now, do you think, for the Fed to sort of say, you know what, we're going to be a little more sensitive with the reduction of the balance sheet to what's going on in the economy?
Well, I intended for it to be reassuring. And for a long time, it seemed like it was reassuring. And the reason it should be reassuring is I wanted to make sure that market participants and the public didn't imagine that as we removed accommodation, we would be using actively two separate tools, and that every time there was a meeting, we would be making decisions both about the short rate and the pace of runoff. I could envision nothing more confusing.
Right.
So the idea of saying, look, we're going to use one tool actively, short rates.
Okay. The
balance sheet, we will run off very gradually and in a way that is completely predictable. We have specified in advance. There's nothing more to learn about this. That will go on. That's what autopilot meant, and I thought it should be reassuring, and I think for a long time it was. Well, what it didn't mean was that we wouldn't pay attention to possible impacts of the runoff on market conditions. And if there were some, well, and after all, we had bought all those assets with the idea of pushing down longer rates.
So you think it's right now for the Fed to make that change and be more sensitive with the balance sheet?
Well, I think they should make clear that they're watching carefully what the balance sheet runoff entails, and will be sensitive, and offsetting it could mean making changes at the short end, not necessarily immediately making balance sheet changes, but it's probably important to signal that people are not asleep and ignoring the impact of that on the economy.
Dr. Yellen, thank you so much for joining us.
Thank you for having me.